Hello, I'm Paul from Bezla. Ellsworth Milton Statler, founder of the Statler Hotels chain, built his first permanent hotel in 1907 in Buffalo, New York. It was remarkable for being the first major hotel to have a private bath or shower and running water in every guest room. Many of today's business travellers and cost-conscious guests are on the lookout for a limited amenity product reminiscent of the Statler offering of a room and bath for $1.50. What many guests are searching for is what has become known as limited service hotels. So in this programme, I'm going to look at comparing performance between full and limited service hotels. In recent years, the distinction between full-service and limited-service hotels has been increasingly blurred. Many new limited-service establishments offer food and beverage products available to purchase at the front desk or in booths that allow guests to grab a bite in the lobby or take a snack to their rooms. It is becoming increasingly apparent that the main differentiating factor between full-service and limited-service hotels is the presence or absence of meeting space. For the purpose of this comparison, we took the three higher-end STR segments, luxury, upper upscale and upscale, to represent full-service, and the three lower-end segments, upper mid-scale, mid-scale and economy, to represent limited service. One of the most visible differences is achieved ADR, which for the end of the sample period stood at $170.04 for full-service hotels and $87.33 for limited-service hotels. This is due to the higher-end properties offering more amenities, but also having higher infrastructure costs. Occupancy statistics are also better at full-service hotels, which for the survey period reported occupancy of 72.3%, with limited service properties over 10 points behind at 61.8%. This lower occupancy is partially due to significantly greater numbers of limited service rooms, 1.16 billion room nights, against full service with 649 million room nights. In terms of actual hotel numbers, these stats are even more telling. The survey counted 42,682 limited service hotels against just 9,827 full service hotels in the United States. However, statistics for new developments favour full service hotels, which have been growing at over 1% even during the last downturn. In contrast, the limited service supply change has been less than 1% since 2010. It is worth noting that within the full-service number, the upscale segment's supply growth alone was 3.7%. Given that the fastest-growing brands of the large, publicly traded companies are in this segment, that is not surprising. Historically, RevPAR growth for full-service hotels shows wider fluctuations than limited-service properties. In the strong growth years of 2007 and 2014, hoteliers took full advantage of group and business travel demand, leading to greater percentage change in full-service RevPAR growth. However, the impact of the Great Recession in 2008 was also more pronounced as those travellers stayed away and companies cut travel budgets. Full-service annualised RevPAR declined by almost 19% versus the limited service decline of around 16%. The rebound for full-service hotels was also more pronounced, bringing with it a significant increase in absolute occupancy. In the near future, we expect to see a period where growth in both supply and demand achieve equilibrium. The way hoteliers react to flat or declining occupancy growth and how they use pricing tools to change their occupancy fortunes will be interesting to see. Full-service hotels will probably maintain higher occupancies, so their RevPAR growth figures will probably continue to underperform the limited service RevPAR growth. Due to all of these factors, at this point in the cycle, pricing power should be firmly in the hands of the operators. If Bezla could help with your hotel marketing, visit our website at bezla.com or call us on 888 999 8086. Thank you for watching today.